So investing is really the key thing to note when it comes to long-term stable growth of your assets. And there's lots of different places to invest. Now, you might want to invest in an index, you might want to invest in an ETF, you might want to invest in a particular stock or a sector. And there's merits and downfalls for each of these, quite frankly. So I've got a lot of information here to go through, but this is one of the key things that underpins the strength of the US economy and the US stock market in particular. And that is that the earnings per share, so how much earnings, how much profits you get per share of a stock within the S&P 500 as an average, has been going up over time. And as long as that goes up, generally that provides the basis for equity markets and the S&P 500 as this example to go up. And this reliable uptrend in the earnings per share of the S&P 500 as a whole highlights why the S&P 500 has been so reliable. At periods where people start to question whether the future holds the same, whether the future also points towards strong growth in terms of earnings per share, that's when you see maybe the market pull back a little bit, and you'll see the price to earnings ratio start to withdraw. And you see that on the bottom here. More recently, markets pulling back. The earnings per share of the market hasn't rolled over. And we're coming into earnings season, which has been strong so far. And so you're seeing the price to earnings ratio start to moderate somewhat. When you look at sort of real rates of return historically, there's a number of different places you can look at and try to see where your sort of best return's going to be. On this occasion, you can see here, global equities have been the outperformer, US large cap equities, and then you sort of work your way down in towards the bottom end. Sort of commodities are very much a mixed bag. I mean, ultimately, you can see these huge swings in terms of variance with the sort of top and bottom marker, and then the average in the middle here. But the more reliable ones, where you're looking at the withdrawal, sort of the downside moves being minimal, you're looking at US large caps, you're looking at REITs, which are real estate investment trusts, typically around the US. Those have by and large been the most reliable ones. So it's a question mark of, do you invest in the US? Do you invest in the rest of the world? And certainly this has been a big topic recently because US markets suffering, Donald Trump certainly trying to bring this question mark around, is this US exceptionalism over? And US exceptionalism essentially means, like, why do people perceive US markets to be better than the rest? And Donald Trump at the moment has people questioning whether that should be a different answer from what we've been seeing over the years. If you look at here, the relationship in terms of outperformance or underperformance of US markets against the rest of the globe's equity markets, by and large, the line has been in the top end more than it's been in the bottom. Pullbacks back below this threshold, the zero marker, which is where we are at the moment, tend to be relatively short-lived, I would say, in nature. Periods above that line where US equities outperform tend to be more protracted in nature. So I would say that historically the US markets do provide the basis for more reliable uptrends. There's a number of different reasons for this. These are just some parts that I find interesting. First and foremost, there's a massive number and percentage of shareholders over in the US. So there's a huge market participation in the US, and the US has a huge amount of consumers as well. We also have the fact that the US has not only a massive population, but also a very high wage, right? So $80,000, the highest sort of wage here, average wage of any of the major countries in the OECD. The only others that are above that are the likes of Switzerland, Luxembourg, Iceland. They're all absolutely tiny. But certainly if you're to compare it against many of the other countries within this, you can see why the US consumer, given its size, given the disposable income that they have, they provide the basis for particularly strong businesses out there. And therefore, those strong businesses are able to buy up the smaller but successful businesses from around the world. And so that US dominance, I don't think, is necessarily going to change. Wage growth remains strong in the US. High wages, strong consumer base, massive population. It provides the basis for the US to remain absolutely key. Now, we can see here the S&P 500 historically has been very reliable. We do, of course, have down years, and you can see we also have significant pullbacks. These yellow dots on the bottom highlight that within these bullish markets, even in years where you see very substantial gains, you might see a very substantial pullback. So retracements are part of the game, quite frankly. So what you're seeing at the moment is not necessarily a complete break from the norm. There is a lot of rhetoric around the question marks on whether this is the beginning of a phase where we need to call into question whether this trend, everything that we're seeing here, is over, whether the outperformance of US markets is over. And certainly recently we've been seeing some strength for other parts of the world. The Chinese market had a period, European markets having a strong period, in particular the DAX, and the S&P 500 and the NASDAQ having some question marks being raised, given the fact that Donald Trump is potentially breaking trade relationships around the world. But we've seen signs of him rowing back from that. He doesn't want to break the US economy. He doesn't want to break the US stock market. But he clearly wants to achieve some gains over the near term. So I would say that there's going to be some volatility. But if you see here, volatility is inherent within these markets. We do see pullbacks. If you're looking at the sort of more regular pullback, you would say it's probably somewhere between that 0 and 10% mark, right? But you also then see some pullbacks into the 20s and some much deeper than that, your 30% pullbacks and alike. But generally, these markets move higher. We're coming off the back of two sort of mid 20% gains for the S&P 500. So there is a good chance that this year is somewhat of a year where we sort of take a little bit of heat out of the market, so to speak. This highlights that same thing, right? So this highlights the size of those drawdowns within the S&P 500. And certainly since 2013, we have seen pullbacks, of course. But, you know, it's relatively stable. And we do have protracted periods where it's just record high, record high, record high. So when you see a pullback, doesn't necessarily mean that this time is the end. You know, this time it's different. Ultimately, this market has been underpinned by strong earnings growth, a strong US economy, a strong US investor base, growth around the world. And we need to see, of course, some breakthroughs in terms of the discussions between the US and China in particular. But if we do see trade deals coming into the fore, then soon enough people want to get their money back into equities. I thought this was a particularly interesting chart, and this is because ultimately when you're looking at a long-term uptrend, you might say it's very easy to just buy this on a regular basis, on a short-term basis, let's say if you're a day trader, and you'll be right more than you're going to be wrong. Well, actually, as a sort of average return on a daily basis, you're looking here, you know, at essentially near enough a 50-50 chance that the S&P 500 is going to be higher rather than lower. So that would make it highlight essentially that it benefits you to be a long-term investor if you want to be taking advantage of this long-term trend. The short term, it's more uncertain and you're as likely to be right than wrong on a daily basis as to whether it goes up or down. But generally over time, you would say, considering the fact that the long term it goes up, over the short term it can go up or down, you would say that by and large the gains would likely be larger than the losses. So here is a breakdown in terms of relative returns by asset. And I think these charts are particularly interesting because ultimately what you want to find is the most reliable investment. And so the ability to look and see which assets are the most regular outperformers, that's going to be key behind then gauging where you should park your money. Notably, if you look at the top right, so the year to date at the moment, you can see that it's international stocks that are outperforming. So this is where people suddenly say, well, maybe it's the time for everyone to plow into non-US stocks, right? Like I said, the likes of the DAX, the likes of sort of Chinese stocks, things like that, right? But let's look back and see how international stocks have done in the past. Is this going to be a flash in the pan? So of this time span, there's not a single year where international stocks have been the outperformer, the number one performer of the year. Aside from that, we've got 2 years where it was the second highest performer. And if you look at the bottom, we've got 1 year where it was the worst performer and 1, 2, 3, 4 years where it was the second worst performer. So these are notoriously volatile indices in terms of whether they outperform or underperform. They're certainly not the reliable outperformer, I would say. And so where are the reliable outperformers? Well, they're very clearly in US large caps. You can see the last 2 years, US large caps, the outperformer. 2 years prior to that, they were second in line. The year before that, they were third. The year before that, they were first. And then if you look at the early part of this, you've got 3 years in a row where they were second, 2 years after that where they were third. So out of this time frame, there's been no time where large caps in the US have been in the bottom 3 of these segments. So it highlights how reliable US stocks have been. Of course, you can all take your view on whether Donald Trump's going to break this. But certainly a lot has happened over this time frame, right? And US markets have continued to do incredibly well. So when you're talking about investing, the most reliable place historically has been in US companies, but also most notably US large caps. Aside from that, you can see the small caps do have their time. You can see 3 years where US small caps were the outperformer. And so at the moment, they're the worst performing of the lot. But certainly you would say that essentially you're going to be taking the same kind of view as, okay, let's say Bitcoin is the outperformer within crypto, but there's going to be periods where there's smaller coins catch up, or gold has periods where it's the outperformer, but then when it's doing particularly well, then you see the likes of silver outperforming. Similar kind of thing. I would say the reliable one out of the two is going to be US large caps, followed by US small caps. International equities, they have their time. But if you look over a long period of time, US equities always outperform. And this is a rather busy chart, but this does have a lesson to be learned, right? And that is that, let me just put this into full screen. Here is a breakdown in terms of all of those other international markets, right? And the one point that I wanted to make here is that it is a lot more unpredictable in terms of what's first, what's last. You know, it's much more difficult to spot the trends within this. And what does that teach us? Well, it teaches us that essentially trying to find that one market that's going to outperform the US equities at a time can be very difficult, because there's no one market here that really stands out as the one that I'm going to be able to hang my hat on as the major reliable outperformer. And so you're going to have periods where you see outperformance for other markets against US markets. Right now, we're talking about the DAX. Recently, we've been talking about the Hang Seng. However, it's quite difficult to ascertain exactly which ones those are. So when you're talking about investing, this might be a case of having a portfolio where if you are investing in indices, it's going to be heavily geared towards the US, and then you're going to be looking at maybe some of the smaller ones in a more sort of tactical sense. And the reason why we see this high valuation over in the US, well, we do see high valuations in the US, and one of the main reasons for it is exactly what we've been showing you, right? Which is essentially that US markets are reliable outperformance. And that means that we generally attach a higher valuation to it. That valuation generally we will use a price to earnings ratio. And so what we've been seeing recently is this surge in the price to earnings ratio of the US markets with the large light blue line. But now it's starting to come off. And so what generally happens is when markets are going through a period of concern, when markets have significant selling pressure coming into play, those equities, those indices that have high valuations attached to them can often be the major underperformers, right? It's the same kind of thing that we're seeing in terms of the big tech names, right? So big tech, you have huge valuations based on huge future profits. Excuse me. As soon as the outlook changes for the global economy, people start to dial down those expectations. Suddenly those metrics, those multiples that are being paid for the company's earnings start to unwind. So generally, US markets will be attached to a higher valuation, but they will typically be at risk if you do see a major sell-off in particular if it means that the US economy is going to be suffering. And the fact that this is a sort of US-centric Trump thing at the moment, and we've got those massive high valuations over in the US, it really does point towards the possibility of underperformance. Excuse me, I probably should have got some water. But so, yeah, so you've got the outlook for the long term is positive for US markets. We do see outperformance, and that provides high valuations alongside the fact that we have big growth names over in the US. And the fact that we're pricing for future growth means that economies like the US, which are expected to have high growth with the AI boom and the like, means that you have higher valuations. So look from a historical perspective. If you see a index and it has a relatively low valuation compared to historical norms, then it does provide the basis for you to see that as a potential opportunity. And we can see that here, right? So this is a 12-month forward price to earnings ratio relative to the past 20 years. The US, we can see here with the orange dot, is very high compared to historical norms. The historical norms are around the sort of blue band and the grey dot, essentially. And some of the other markets here are sort of more around the middle. So they're almost fairly valued, essentially. Essentially, if you've got a company that is valued at 20 times earnings, but the norm is 13 times earnings, you might say it's overvalued. If it's valued at 13 and it was always or typically 13, you might think it's fairly priced. And so US markets are still in a position where this is a high valuation compared to historical norms. To you, that might mean that you look elsewhere and you can look at some of these other areas and say, okay, you know, the United Kingdom potentially looks relatively low valuation compared to historical norm from a forward price to earnings ratio perspective. But you also have to bear in mind where you think the growth is going to come in the future. I would argue that the AI boom does provide the potential for much higher margins for some of these businesses because they're going to be able to bring down costs. Right now, the AI push is really around big tech, and big tech are spending in a big way. Now, in the future, it's not necessarily just going to be big tech spending to develop all of this AI. Instead, it will be businesses trying to integrate AI. They won't necessarily have all this spending that you would associate with the big tech companies, but they'll be utilizing those big tech companies to be able to incorporate that product into their everyday business. So they will have costs, but by and large, I would expect those costs to be overshadowed by the significant gains they get as a company going forward. So what I would say is, you know, a lot of these countries might have relatively slow growth in the past, and it makes sense to sort of look into the different types of businesses within those areas and see whether you think that those businesses are going to be helped or hindered by the change that could be coming down the line. That's another way to try and look at potential areas of opportunity within the markets at the moment. But certainly you're looking here and you're saying US markets still look relatively overvalued to a large extent. And a part of that is down to expectations of what AI is going to do for the tech sector in particular, but the whole market as a whole, really. I think, you know, you look at the S&P 500, how many other companies are going to be able to integrate AI processes into their business to be able to ramp up the kind of profits that they can make down the line. And of course, that then gets passed on to investors. So when we're talking about the idea of, you know, investing to stay ahead of the game, ultimately, you know, we're all in a very much changing world, right? So things are going to change. And there's been a lot of talk about the idea that AI is going to make it so, you know, you don't barely have to do anything. You don't have to lift a hand with your job. AI is going to do most of your job for you. You're going to work less. You're going to have a great quality of living. In my mind, I think the winners here are going to be the businesses, right? Because the businesses are going to be able to lower their costs. They're going to hire less people because AI is going to be doing a lot of it for them. And so investing in the companies that are going to be benefiting from this wave of cost cutting, I think makes a lot of sense, because uncertain future, but I'm pretty certain that the benefactors will be the businesses themselves that integrate AI into them. And that should help with margins going forward.